Vinayak, I think we can start. Good morning to you all. Thank you for joining us today on a holiday. Happy Dussehra to you all. Me and my friend, we were just, discussing what can we give the attendees on a Dussehra. Like Dussehra, what does it signify? It signifies cutting the 10 heads of Ravana, right? So why not talk about 10 financial mistakes or 10 financial letdowns that we got to cut out of our lives? So I hope this session is fruitful for you all. So today's session will be taken by Vinayak, financial planner, and Tharun, myself, business engagement specialist. So let me just take you through a quick run of the 10 financial mistakes that we can cut out of our lives. The first financial mistake being having no emergency reserve. Okay. The second financial mistake is trading stock and options based on tips. The third is being underinsured. I'm sure this one will be very helpful for you all because we have an interesting case that my colleague would be sharing to you all. Then fourth would be confusing insurance for investment. Why we should not have investment and insurance in this bucket. People usually it's beneficial, paying the premium and getting back the premium with a good return, but there is a sickle there. You need to see what is hidden, what we are failing to see. So my colleague will be taking you through that too. Then having too much debt or a lot of debt is a burden, which I'll be talking about. Next slide. The sixth financial mistake would be procrastinating your investment. Always, saying, okay, I'll start my investments tomorrow, but tomorrow fails to come, right? So people are not seeing that. So we'll be talking about that, an interesting case in that too. The seventh financial mistake would be having no proper vision. What are you investing towards? You need to have a goal to invest towards. Otherwise, there won't be any motivation or any commitment from your side. Okay, so the eighth financial mistake would be being too conservative. And that's very common with Indians. So, right, like we'll talk about an interesting concept that falls under being too conservative. The ninth financial mistake would be why people should, keep away or stay away from, pyramid schemes or unregulated markets. When I talk about unregulated markets, there's something called as, chit funds. Why our clients or leads to go and invest in chit funds. The 10th financial mistake would be having no financial plan. So people usually, don't give a financial plan the value that it demands or that it requires. Financial plan can be helpful for you all. In any case, it'll map you from your current position to your final goals. And my friend will be talking about that to you. So my colleague would be taking over from here on. So thank you.
So thanks a lot, Tharun, for giving a brief intro. And thank you all for joining on a auspicious day of Dussehra. So as we saw, it's like there are a lot of financial mistakes and blunders people usually do. So today we are going to talk about top 10 financial mistakes that people do. And we are going to provide a strategy how to rectify that mistake and to go on in life in the financial journey. So as we all know, in the tale of Ramayana, it's like one thing is there was an emergency. There was some setback that happened to Lord Rama. Goddess Sita was abducted by Ravana, and Lord Rama and Lakshmana had to fight a battle to get Sita back. So what happens is, likewise, any financial misfortune can fall on any of us. So there may be any setback that can happen, job loss, medical expense, any emergency expense can pop out of anywhere. So what is important is to having an emergency fund ready for the situation. So you may ask, what is emergency reserve? So emergency reserve is a fund of yours that will have a backup. So if any financial setback happens to you, you will have funds ready for the specific thing. So you may ask, how can I build an emergency reserve? So ideally, there's a thumb rule. So your 6 months to 1 year of expenses can be set aside towards building an emergency reserve. And how to build that would be, it's like you can gradually start building. It's like monthly contribution from a lump sum. If you have already, you can just park in a lump sum amount. of your 6 months of expenses as a contingency reserve or emergency reserve. With this, what happens is usually when investors have a financial setback, they go and touch the investments and they lose out on their wealth creation journey and the compounding. So I would recommend this. First mistake that we can avoid is no emergency reserve. So from today itself, we'll try to build an emergency reserve for a future. If there's any financial setback, God forbid, so we'll have a backup ready. So you may ask how to build an emergency reserve. So you can build it in fixed deposit, short-term debt instruments, savings bank balance, etc. But I would recommend not to building the same in savings bank balance because people tend to use it for other unwanted expenses too. So having it in something like an FD or a short-term debt instruments or a short-term mutual fund would be great. So moving forward, so trading based on tips, that also on stocks and options. So right now, a lot of Tom, Dick, and Harry are there on social media giving stock advice and whatnot. So usually it's like I have also seen a lot of my people in my friend circle or clients too. They fall in this trap. So they fall in the trap called as pump and dump. So what I would recommend is find your Jatai. Stick to a person whose ideologies match to yours and let him guide you through your investment journey or a financial journey. So that would be one thing. Okay. So being underinsured. When I was a kid watching the anime called as Legend of Ramayana, I always had a question. If there was an extra layer of protection other than the Lakshmana Rekha itself, will the story of Ramayana happen? Or would Ravana abduct Sitama if there was an extra protection other than Lakshmana Rekha itself? So that time I didn't have an answer, right? So being underinsured is also one of the important thing that people don't consider. People go and start the investment journey. But one thing before starting any investments, I would recommend is having a term insurance and health insurance. Let's talk about health insurance first. So you may say, I already have a company sponsored health insurance cover. So why do I need a separate health insurance cover? So for example, if anything suppose happens to you, if any job layoff or if you're terminated from your current company or if you leave your current company. So in that period, if any medical mishap happens to you, you won't have any health insurance backup to cover you. So in that case, having an individual health insurance policy is very important if you're single. And suppose if you have family, having a family floater health insurance cover is really important. Apart from that, term insurance is also one of the important thing that you need. So what is a term insurance? Suppose you are a bread earner and you have a lot of dependents around you who are living on your salary or depending on you on your finances. So suppose any mishap happens to you on your death, your family won't be covered in the financial space. They won't have any financial resources to take care of their expenses. In this case, what happens is having a term insurance would help. So why term insurance is important is with the lowest premium, you will get a biggest sum assured. So what would be an ideal term insurance cover? It would be actually 25 to 30% of your annual income. So suppose, for example, I am earning 2 lakhs per year. So my term insurance cover would be somewhere approximately around 50 lakhs. So this is just a thumb rule kind of thing. It's like 25 to 30 times. There's something called as human life calculations. After doing a human life calculation, you will get the approximate amount that you need as a term cover to taking care of your family's expenses and needs. So having a term insurance cover is one of the important thing you all have to consider if you have dependents. And sidely, having a health insurance cover is also too important. Okay, so let's talk about buying investment linked insurance product. So most of the people usually ask me why to buy a term insurance. I'm just paying off the premium and I don't have any money back guaranteed, or after 10 years, I won't get my money back. The purpose of term insurance itself is a risk management tool. You are just paying roughly approximate premium of total 3 lakhs over a period of 20 to 25 years, and you're getting around 50 lakhs to 1 crore of term insurance cover for that premium. So in that case, it is just for the protection of your family if you have dependents. But people go and fall in the traps of investment linked insurance policies. Let's see how these products are usually marketed. So just 22,000 per year for next 12 years. And at the maturity, 3.5 lakhs 12x to 13x return guaranteed. It's too flashy and people would actually fall in this trap. I won't actually blame people falling in this trap. So, and apart from that, you will also get a life benefit of 3 lakhs. So when my team did the calculation and math, we found out after paying premium of 22,000 for next 12 years, the total XIRR return was only 4%. Yeah, a savings bank and recurring deposit will give a better return than that, right? So one thing is, okay, suppose I paid my premium still last 10 years and I want to exit the policy. So what are the clause and conditions, terms and conditions in the policy would be? Surrender value would be 30% of all the premiums paid, less first year's premium. So the total premium paid would be 2,27,860. And what the surrender value would be? Just 45,000. So yeah, I'm not making any profit out of it and I'm ending up paying up more than enough. So what is the other strategy to get out of policies like money back, endowment, etc. would be there's an option called as paid up option. So in paid up option, what happens is, so the terms and conditions for every policy would be different. But usually what happens is if you pay your first 3 premiums of this life insurance policies, after that, you can convert your insurance policy into a paid up option. So what happens in paid up is, so your sum assured value, the maturity value, whatever was there, suppose for example, 3.5 lakhs after paying 2,27,000, something like that, it would actually get adjusted to the first 3 years of premiums paid. So in that case, what happens is, for sure, you will be getting only 4% return. But after that, after 3rd year, you are not paying any premium. So you are actually locking the 3 years premium and waiting till next 12 years and getting the adjusted value. That's actually the better way to exit out the policies, exit these policies. So other than that, what happens is usually it's like, how can you convert your policy into a paid up option? So you can just inform your relationship manager that I want to convert my life insurance policy into a paid up option. Or else, if you just stop paying your premium, your policy would be automatically converted into a paid up option. So I wouldn't recommend that. You can actually inform your RM and he'll help you out in converting the policy into paid up option. So what we can do now is, if you have a lot of life insurance policies, you can get it reviewed by an insurance specialist or an insurance advisor and make the right call. So I would recommend, please don't go and commit into the policies like insurance and investment linked product, because insurance is a separate part and investment is a separate part. We don't have to combine everything and we don't want any subpar return, right? So 4% of return doesn't make any sense. That also for just sum assured cover of 3.5 lakhs or 3 lakhs. So I would recommend is keeping this both separate, having a separate term insurance and a health insurance plan, and having a separate investments. That would be more than enough. So moving forward, so I'll just add some of Mahabharata aspect in our Ramayana story. So we all know the story of Abhimanyu, right? And the story of Chakravyuha. In Mahabharata, Abhimanyu knew how to get into the Chakravyuha, but he didn't know how to break through and come out of it. So in the same scenario, without proper knowledge, a bad financial product can cause a lot of trouble to the investor. So there are a lot of financial products in the market, such as ULIP, small cap, LIC policies, and option trading. So I would recommend you to learn the product, have proper discussion with your investment advisor or financial advisor, figure out if the product is going to add value or not, then only go and commit into things like this. So moving on to the next financial mistake, I would be passing on to my colleague, Tharun. So yeah, Tharun.
Thank you, Vinayak. So will you be presenting it for me? Will you be changing the slides for me? Yeah. Okay. So having too much debt, like just imagine, okay, Ravana having 10 heads, and how does he even sleep? Like it's impossible. More than the financial impact, having too much debt has a lot of psychological impacts. It's a burden that people just want to stay away from. So let me just start by asking a simple question. Is having a lot of options today a boon or a bane? Is it good or bad? 10 years ago, when I visited a ice cream parlor, the spread was simple. There was chocolate, there was strawberry, there was butterscotch, there was mango. It was simple. The spread was small, the spread was simple, it was easy to decide. Now, when I enter a Lame or a BR or a, IBACO, the spread is lot. There's a variety flood, Under chocolate alone, there is like white chocolate, dark chocolate, there is chocolate brownie, there is Belgium chocolate. And this makes me as indecisive as hell, like very difficult for me to decide a particular uh, flavor. And another particular pattern that has popped up is these days people uh, need convenience. They need convenience. Convenience has become the need of the hour, with the emergence of online shopping, with the emergence of quick service restaurants, with the emergence of Swiggy, Zomato, with the emergence of Urban Clap, everything can be, done at home, right? So people are looking for convenience. Having a lot of options and having convenience as a priority, we fall into huge debt traps. Okay, these two, behavioral patterns have, transitioned our behavior from save now, buy later to buy now, pay later, and hence debt is born. Okay, so when people want to buy something, like in the past, like when before the introduction of loans or EMIs, when people wanted to buy something, they saved up and then they bought their desired goods. After the introduction of EMIs and loans, it was easy. They didn't have to take up the headache of saving. They just bought it and then they thought about paying later. Not even paying later, they thought about paying later. So that is how the transition has, made us all change our attitude. So talking about, credit cards or talking about EMIs first, there is something called a zero cost EMI. People feel there is no interest in that, but people are wrong. There is a hidden cost. There is a latent cost in the zero cost EMI option. It's how you bundle a package, how you bundle it and how they've camouflaged the interest cost in the package. So say, for example, you're buying a phone, you go to a store fund, and if you have the money up front, you can buy the phone by paying the huge chunk of money. The phone costs 15,000 rupees. There is a store discount of 3,000 rupees. Say if you have the ability to pay 12,000 rupees, you can purchase the phone for 12,000 rupees then and there. But say you don't have the ability to pay anything, but you have the option to take it on an EMI. Then you can't avail the store discount of 3,000 rupees. You have to purchase the phone at 15,000 rupees. There won't be any store discount given to you. Okay. Now, this 3,000 rupees is the hidden interest cost that we all fail to see. Okay. So the 12,000 would go to the shop owner and the remaining 3,000 would be going to the banker. So we would be paying the EMI for this 15,000 rupees in 6 months or 3 months installments. Talking about credit cards, there is something called as minimum due. Credit cards, when you make a credit card purchase, you would have a grace period. If you pay the debt within that grace period, then you don't have to pay any interest. But if you pay it after that, an interest amount would fall upon you. So credit cards have something called as the minimum due. So people think, okay, let me just tell you what a minimum due is. Minimum due is the amount required to pay by the card holder on or before the payment due date, so that the card doesn't get deactivated or any late fees can be avoided. So people think just paying the minimum due will be helpful for them, but just paying the minimum due is very risky. If you just pay the minimum due, I'm sure the card won't get deactivated and I'm sure there won't be any late payment fees. But there is something called as interest that will be burdened on your outstanding balance. Okay. So if you keep extending your credit period, you've surpassed your interest-free credit period and you will be paying heavy interest. And especially when you take credit cards, the interest is charged per month. They charge 3 to 4% per month. Just imagine if you're paying 3% per month in 12 months, it's 36%. That's a lot of interest, right? And how to, we've spoken about a few problems related to debt. Let's talk about certain solutions. One solution that we should all, give importance to is prepayment. Let me talk about two methods here. One can be, the snowball method. This method involves the cardholder paying off the smallest loan balances first, After paying off the smallest loan balance, he moves on to paying the next smallest loan balance. By closing off one loan after the other, he's increasing his rate of debt repayment. Okay, so if you close off a loan, doesn't it give you a sense of satisfaction? Doesn't it give you a sense of motivation? It evidently does. So this method gives and motivates people to close off their loan balances. And the other method is avalanche method. This method is paying off the highest interest rate loans first. For example, take a loan balance amount that is huge and having a highest interest rate. To pay off this loan, huge loan balance, it'll take a long time. So if you prepay first this particular loan balance, then you can save some amount of money in the longer run. So if you want to save money in the longer run, avalanche method is a good method. So these two are the methods that people can think about, in order to save money and close off their loan balances. One more cautionary advice: please don't, compromise any EMIs for one particular EMI. Okay, say for example, you have a car loan EMI, you have a home loan EMI, you have a phone EMI. You prioritize the car EMI first, for example. For that, please don't forsake the loan EMI or the phone EMI. Every EMI will have a minimum monthly installment. Pay that. Over and above that, if you're able to contribute, then it's good for you. Okay. So this is what is about too much debt. Let's move on to the next slide. The next financial blunder that we do is procrastinating our investment decisions. So this was, let me just recollect one of our client calls to our advisors. So this was not even a year ago. So the markets were at the 16,000 levels then. Okay. So we advised our client to start investing then, but she didn't start for the sole reason because the markets were high. She wanted to time the market. She wanted the markets to fall. And then she said she'll start investing. But from there on, the markets didn't fall. It just kept rising. And in the month of August, it touched the 20,000 levels. So in the month of August, she called up and she's like, no, I don't want to procrastinate this anymore. So let me start my investments. Okay, so people try to time the market. See, each of us have our day jobs, right? One might be a lawyer, one might be a cop, one might be a software developer, etc., etc. So after finishing our jobs and we come back home, we don't have the mental space or the energy to do research on a company or a mutual fund and then select a particular mutual fund that will be fitting our goals and our financial capabilities. It's very difficult. People have taken this as a career, say financial advisors, fund managers, investment strategists. So please avail their help to, build your wealth and achieve your financial goals. Their expert opinion will matter no matter what. And another important and interesting fact, the Nifty 50 jumped from the 10,000 to 20,000 levels in a matter of 38 months. That's nothing other than 3 years and 2 months. So this is evidence to the market being evergreen and fresh and filled with growth. So as our co-founder always says, markets only belong to the believers. So let us all believe there is growth and let us invest towards our financial goals. No proper vision. Okay. So this is a very interesting story in Ramayana. Okay, while when the Vanara Senas and Rama was building a bridge to Lanka, there was a squirrel, a small cute squirrel. It also wanted to help in some way. Its goal was to help Lord Rama. Okay. So what it did was it carried small pebbles and it brought it and put it in between the rocks. The Vanara Senas, the monkey army of Lord Rama, they all laughed at the squirrel. Hey, how is this small contribution going to help us? This is of no use. And they mocked at the squirrel's contribution. Then Lord Rama made the Senas realize that those small pebbles actually help in connecting the rocks and keeping it afloat. Okay. So people, the thing is, having a goal is very important. You should know what you're investing towards. So even the smallest of contribution will pay huge benefits to you much later. So please invest with a goal. Please save with a goal. A goal will give you, passion, commitment, and focus. So please have a goal while you're investing or saving. Eighth, being too conservative. Okay, so to go to Lanka, Rama had to cross the sea. Okay, what if he had waited? What if he had not built the bridge that connected him to Lanka? What if he waited for someone to build a ship? Or what if he waited for the Wright brothers to build a aeroplane? Okay, that would have taken ages, right? So he made quick decisions and he took the risk by building a bridge, and he crossed Lanka and he saved Mother Sita. So it's time we all start taking risk into our investment frameworks. So let me start with something called as a financial goal. What is a financial goal? A financial goal should have these three things. It should have a timeline, it should have an objective, and it should have a monetary value. Having these three things, you can term something as a financial goal, and everyone has a financial goal, one or many financial goals. So all of us should focus on achieving that financial goal. Okay, our objective is to achieve the financial goal. So take, for example, milk prices. Milk prices increase year on year by 8 rupees. Then think about education cost. Then think about marriage cost. Think about house purchase. For example, take US education cost. It increases by 11.4% year on year for the past 40 years. Okay, in Indian rupee terms. So if you're saving for this particular financial goal through an FD or an RD or a savings account, this is not going to be viable. An FD would be giving you 6 to 7% in India. An RD would be giving 5 to 6%. A savings account would be giving 2 to 3%. But this is not enough to beat inflation. Your sole focus is to beat inflation. Okay. If you're investing in a 6% FD, say you're investing 1 lakh, for that 1 lakh to become 2 lakhs, it takes 12 years. So it's time we all take the necessary risk and start investing in the markets so that we can all achieve our financial goals within the set time frame. Okay. So I'm not saying FDs and savings account and RD should not be a part of your portfolio. I'm just saying that it should not be taking up your entire lot. Okay, so your portfolio should be carefully constructed. It should have an equity component. It should have a fixed income security component. It should have a commodity component. It should have a gold component. So a carefully constructed portfolio will definitely aid you towards achieving your financial goals. So people often misread this, going for safer investment avenues. People think they can stay away from risk, but there is a risk there too. Okay, so they say it in the financial, world. A rupee worth today is more than a rupee worth tomorrow, right? So there is something called as the time value of money. The time value of money fades as time passes. So in order to beat that, our only solution is to invest through the markets. Okay, my last point would be, pyramid schemes or the unregulated market. So we all heard about the S bank collapse, right? So the bank fell into a debt trap, and it was a very difficult time for the bank. But how did the depositors get back their money if the bank was in a debt trap? Banks are a very highly regulated segment. Okay, who regulates bank? The Reserve Bank of India regulates all commercial banks. So any issue that arises in the banking industry, RBI is there to solve it. Okay, so there is a regulatory mechanism there. Now let's take mutual funds. There is a regulatory mechanism there too. There is SEBI. Okay, so any issues that arise in the mutual fund industry, SEBI is there to step in and solve the issue and safeguard the investor confidence. But when you go for chit funds, there is no prominent regulatory mechanism in place. Okay, so we need to stay away from such unregulated markets, and we need to keep our savings, financial savings, protected from Ponzi schemes and pyramid schemes. Okay, so there were a lot of Rakshasas and Asuras in Ramayana. So, Rakshasas, disguise themselves as good people and they approached the good crowd. But you need to have the eye of Rama and Lakshmana. They knew like which they were able to, find the difference between good and evil, and they took the right steps. So it's time we have such a perspective between what's right and what's wrong. So kindly stay away from such unregulated markets. Now my colleague would be talking about the no financial plan blunder. So Vinayak.
So yeah, thank you, Tharun. So we usually celebrate Dussehra for the one thing, to celebrate the victory of Lord Rama over Ravana, right? So he had one goal and one objective, to free his wife from Sri Lanka and come back, and he actually achieved it, and it was successful in that. So that's why we celebrate Vijayadashmi, the Dussehra. So most of us, while starting investing, we don't have a specific financial goal or future goal. So I would recommend you is having a financial goal first, because having a financial goal, you will have a better clarity what are your future financial goals, then you can start investing towards a specific goal, because your timeline, your risk, and the value of the goal, that is cost of the goal, would be different. So in that case, you have to consider inflation, you have to consider your risk tolerance, risk capacity, everything. So in that case, having a financial plan will give you a better clarity and set you for the target of achieving this financial goal. So this Dussehra will try to rectify our financial mistakes. And this 10 mistakes are just the normal top 10 mistakes that we see in our day-to-day life. So there are a lot of financial mistakes people usually face and do fall in the trap too. So we can try to figure out and rectify these mistakes. And in this financial journey, we can be financially successful and achieve our financial goals. And yeah, that would be from my end. Thank you all for joining for this webinar on the auspicious day of Dussehra and giving us your valuable time. So yeah, passing on to Tharun, if you have any closing notes to say.
Thank you, Vinayak. Thank you very much. Yeah, thank you all for joining us today. Especially this is a holiday, and we really didn't expect this crowd to turn up. So I hope this session added value to you all. So thank you very much, and hope to see you all in the future for more such sessions. Thank you.